real estate and development. We will try to look at lessons learned from the crisis, potentially or not. We've seen a lot of hotels defaulting on loans. We've seen a lot of hotels being repossessed by banks, although a number of banks still are extending and pretending.
We're pretty much back to a growth mood in most of the markets operationally. We do see projects coming back. We do see banks coming back providing finance. I was absolutely stunned attending MIPIM this year that the overall real estate mood was so excited. Lesson learned is I think people would like to be a little bit more careful, but what we see at the moment is a wave of capital, both equity and debt, chasing a minute amount of deals. So if you want to be successful, you've got to be extremely aggressive.
There is a lot of equity around. Whether we have learned from the crisis, I don't think so. I think that people have the tendency to forget and to close a deal at any price. In fact, the reality is, what is the EBITDA produced by the hotel? What is, the real estate value? And at the end of the day, we have to buy cheap and sell high.
In terms of development, what do you see more cautious development? Because obviously some of the development was also a bit crazy at the time, and whether it's simply the development itself or the kind of contracts associated with the development.
I think the balance of risk between the owner and the operator has changed and moved significantly. Now we see more and more included in the management terms, some clause about guarantees and performance tests, and also key money and co-investment that are often required to close a deal on a management contract. On the lease agreement, we also see a trend where we see less and less fixed lease and more sort of a hybrid lease where there is a variable component to probably to adapt to the current market conditions and the risk associated to it.
Do you see, as you mentioned, that realignment of maybe of risks and risks going back towards some of the operators, or having to be paid by the operators or taken by the operators?
I think generally the alignment of interest and the appropriate balancing of risk is key in the relationship. Sort of in the last cycle, a lot of the transactions were driven by operators selling their real estate, obviously then subject to a long-term management agreement, which today makes a lot of owners suffer because the only party that makes money is the operator. And that is that had to change.
We are an asset owner and an operator. Therefore, our first focus is really long-term, adding value to the real estate through operations. We are not, like the big chains, which are very much focused on the brand and the coverage and the number of units. We really look into more of the return on our own equity.
At some point, if you really have to buy your management contract and then provide the performance guarantee, you end up with an hybrid management contract, which in a sense it's closer to a lease. Key is that we end up with a contract where we both understand that we have to make money. It's a case-by-case approach. But back to the management agreement, I think it really depends on the market and the competition also on this market between the different brands and operators.
Have you changed the way you work? And if so, do you need new competencies?
I think generally consultants tend to be over-optimistic in good markets, and they tend to probably be over-pessimistic in bad markets. You're looking at past transactions in order to verify your cap rates and your yields and your discount rates.
We do pretty much a budgeting exercise at a very early stage of the underwriting, and that's because we want to make sure that we cover every aspect of the operational risk.
For me, 3 or 4 indicators allow me to see whether I can go for the project or not. All hotel companies are using the same methodology, which is the DCF, and we are looking obviously at comparables. But one major difference is that most hotels are hotels and cannot be converted into anything else.
DCF, whether you exit planning for exit strategies, any kind of budgeting exercise, all of that is linked to the forecasts. And it's essentially driven by top-line elements. We all know costs are more subject to inflation than ADR. ADR is more volatile relative to cost.
Forecasting ADR, that's probably the most difficult part of our lives. You know, occupancy, everything else is probably very much market-driven. ADR is asset-driven, location, brand, general manager.
A deal, especially in business development, is quite difficult. It requires a lot of team effort, a lot of different, people from different support function or operational support. You need to lead these guys. You need to get the consensus. We need to bring in, new blood. And I'm happy that at IMHI you have people who are not coming only from the hospitality business.
What might be the big trends affecting the hotel real estate industry for the next 5 to 10 years? And what are the key markets that you anticipate to grow during this time?
I would say Latin America and probably Middle East and to some extent Asia also and China is still showing some good prospects.
China will be a big market. India will be a big market. However, I do believe that we should be focusing on other market, on niche market. On top, on just, looking into all the demographics, see what is the consumer habit and try to see where we really can do something different.
We're looking at 3 big trends for the next couple of years. One is an increase of mixed-use developments. We do see a strong focus from developers balancing risk. The second one is a growing institutional interest in the industry. So we have seen, and we already seen more and more institutional capital moving into the hotel real estate industry. Today, it's much more sophisticated and it's accepted as a asset class also by institutional investors. And the third one, which is kind of the result of the second one, is the growing importance of asset management in terms of repositionings, restructurings, renovations, capex at the right point in time.
One of the key takeaway for the students in the room, I think, is it's not on the technical side that you're going to differentiate yourself. It's probably on the way you manage relationships that you're going to differentiate if you want to get into that industry. So thank you very much again to the panel.